All right, well, cheers, and welcome everyone to Happy Hour with the Lincoln. We are now on episode number 53. That's right, 53 of these things. That's a lot of happy hours. There's also a lot of whiskey, too. Anyway, I hope over this time it has been beneficial to you. And if this is the first time you're watching, or if you want to know what happy hour is, this is where week by week I'll do my best to try to answer all of your stock market related questions in the attempts to try to make you a more profitable and professional trader. Now, if you have questions that you think would benefit the trading community, send them over, support@thelincolnlist.com, and I'll do my best to get them featured on some of these upcoming episodes. And if I don't, I'll at least get back to you right away and answer that question for you. Also, if you're trying to align yourself with the professional trading community, you're trying to learn the most that you can learn out of trading and surround yourself with successful people, visit our live trade room every day the market's open. Right here's the link. We Trade Live. Just click on it if you can. It's also down in the description box. It'll take you right to our room. So what am I going to talk about today? What good stuff do I have on tap that will make us all smarter and better? I think you're going to like what we have going on here today. So let's get right into it with question number one. All right, so question number one is, hello, I'm wondering if you can pass this question on to Doug. Doug reads his own emails. Doug's got this question for you right now. I keep feeling that the stock market is overdue for a correction. In a few of his videos, he was talking about the dot-com crash and the financial banking crash. With Doug going through two correction events, are there any signs we should look for it's too late? Yes, there is always a sign. Now, if you followed my story, fortunately and unfortunately, I've had the pleasure, for lack of a better word, to live through both of those corrections in the market. Now, I say fortunately and unfortunately because it was very unfortunate of me, and I blew my account up and went psycho back in the dot-coms because I lost a lot of money and thought I'd never get it back. But the time would come, 8 years later during the financial crisis where I would learn the lessons from the dot-com and the mistakes that I made. And I turned that into one of my best years ever as trading. And yes, there are some signs. Now, I can't guarantee you that the two signs, there were some very similar events that happened. And I can't say that if and when the next one comes that this is how it's going to play out, but they do sort of play out somewhat the same. There's always going to be a different theme. It was dot-coms with companies that had inflated valuations and everybody was jumping on anything dot-com bandwagon, and these companies were just getting all kinds of money. Stocks were going up and they really didn't even have a business plan or a business model. We all know what happened with the real estate going into the financial system and all that kind of stuff. And here we are, and there's been a few things thrown at it. Now, one thing I do want to make clear to everyone out there. Remember, it's not what you think about the market that matters. It's what ends up happening. Now, just because, and what I'm trying to say here is just because it seems like it's due for a correction does not mean it's entitled to, or that one has to happen, because it doesn't have to happen. Maybe we enter this new world order where algorithms and computers take over, and they somehow, with plunge protection teams and the Fed and QEs and all that kind of stuff, they somehow can prop up the market and keep it from being such a disastrous event. Maybe that kind of turns on us like those sci-fi films, and robots take over and the market just goes haywire and none of us can control and we lose all our money. Who knows? But anyway, that's probably not going to happen. But anyway, there are some similarities. And here's what I want to just highlight. It always starts out with an event that causes this instantaneous correction in the market. And then the market sort of shrugs that off. Maybe it's a month later or 2 months later. And it seems like the common consensus among traders and investors, like, whew, we're back to normal again. And then there's this period of normalcy. And then everything just starts going haywire afterwards. So if we kind of look and we go back to the dot-com, I'm going to try to do this by memory. It originally started, the talk about these companies started somewhere around, I think it was late 99 and 2000. I could be completely wrong. My mind could be fizzling out. But I do remember it was like March of 01. The market really takes a heavy hit. Like, it finally starts to get sick and tired of this, or more stories start coming about of these inflated evaluations, and the market just gets smashed. And then throughout the summer, it's kind of hanging in there. Nobody's really paying attention. But then, of course, throw in 9/11 and a couple other things there. Next thing you know, the thing just turns into a free-for-all. Kind of the same way with the financial crisis. There was a big sell-off event, happened earlier in the summer, And it wasn't really until we moved into October, November, did we see where the correction really started to happen, where panic really took over. So you have that first initial event, and that gets people shaken out and gets them on their toes. But then it always seems like it has this period, whether it's a month or 3 months of trading, and it just sits there and people get complacent. They're like, okay, well, I think we're back to normal. And then all of a sudden you start rolling over and panicking. Now, I can't say that that's how it's going to be the next time, or that's a guarantee. That's just two back-to-back situations that kind of resembled each other. And if you want to think about it, if you pull up a chart, I can't do that right now. Maybe I will when I edit the video. But if you look at it, that's kind of what happened. Remember January, the market was just going up every day, and everybody was trying to pick a top, wondering what was going to happen. And then all of a sudden in February, you just got slammed. The market goes right from like all-time highs down into the 200-day moving average. And since then, like around March, we've been fighting that off, right? We've been fighting that 200-day moving average off, which a lot of traders, technical traders, use as a benchmark. We've been fighting that off for a while. Now we're starting to slide back under it. So maybe we're sitting in that. I'm not going to sit here and say that this is what I'm trying to say. I'm just saying, you know, there's a very big similarity there right now. I'm not calling for a market crash. So if the market doesn't crash, please don't yell at me, you know, because I'm going to trade it one way or the other. But it's kind of like that. It's kind of reminding me. That's why I put this question in there. It was reminding me of that because we had that big sell-off there in February and March. And then we kind of gone sideways. There's been a little bit of bullish talk. You know, the market just a couple of weeks ago was really bullish. And people were thinking, okay, well, maybe we're going to go back to all-time highs. Tariffs come out, and then now we're sliding under here. So maybe as the summer progresses, we start to see a little bit of it. But the truth be told is there's no way someone can predict and really what I want you guys to take away from it. There's no way that anybody can predict what time. You know, just because something looks like it's overbought, it feels like it's overbought, it needs to be corrected, doesn't mean that it could be corrected. The policies and things that are put in place for the market, you know, can take months, maybe a couple of years before they really start to dig into the market. So these things take time. You know, corrections take time to happen, and you do get signs, and that's one of the signs. That's one of the things I'm thinking of right now is as we continue to fade, we throw on top of some extra tariff news and stuff like this. This could be a catalyst to cause the market to go through a correction. Now, what kind of correction? I don't know. Most likely there will be one in the future, regardless of what it is. That's the economic cycle of life, and that's the way it works. But take it for what it's worth. I hope I answered some of your questions, and we'll see what happens. Let's move on to number 2. Okay, question number 2 will be, why gamble, man? Why gamble? I like this one. It came in big font, like big, bold font. They wanted me to see this. Why do people play poker or gamble when they can get 300 to 400% returns in option tradings easily? Easily with the right strategy, you can get 300 to 400% returns. You can't make 300% in card games. Do you play poker? No, I don't play poker. Not at all. I don't play any game. I never go to the casinos and play games hardly ever. I don't know why I got this question. I don't know who's ever randomly asked me, a stock trader, whether they play poker. And I don't know what the theory is behind this. So first of all, I don't play poker. Number 2 is, where do you get 300 to 400% easily with options on the right strategy? Where is this right strategy? Because if I could make 300 to 400% every year on my money, sign me up, man. I'm interested in that. You probably can't make 300% in card games. But here's what I want to say about this one, and here's why it's in there. Because this is kind of a recurring theme with people like, why don't you trade Forex? Why don't you trade 300 to 400% options with that super strategy? Why don't you trade cryptos? You know, everybody has their thing, you know? It's like, I'm not any good at poker, but there's probably a poker player that wouldn't be any good at trading stocks either. It's a whole different animal. You know, you just feel something. You just feel like you belong here. It's like your job. You got a job now. Some of you have a job that might not be trading. You have a job now. How come you don't go get another one? You know? How come you just don't switch careers and try something different? You know? Like if you're a fireman, how come you just don't become a lawyer or a doctor, right? Everybody has sort of a niche in life. And this is just where I belong. Trading stocks is what I do. It's what we all do. And somebody's out there, they're a really good poker player. So why do they love it? They get to not just love the financial rewards that they get from it, they actually enjoy playing the game. It's like a hobby too. It's fun. So for me and a lot of us who do trade, it's not just about making money either. It's a great job. It's a great job to work from home. I've said that so many times. It's nice to be remote and be able to work wherever you want. It's also fun. Not on the days sometimes when you lose a lot of money, but for the most part, I can't picture doing anything. Like, this is really a fun thing to do. I'll bitch all the time about it. People in the room tell you, I'm always a curmudgeon, always complaining about something, but that's just my nature. I'm always complaining when I'm making money or when I'm doing, that's just how I roll. I've always done that. But it's truly where I belong. And the reason I'm putting this up here is because, like I said, this whole life that you're living, we're going to get sappy for a moment because this is what happy hours are all about. Like, we're just two people having a couple of rounds. Like, hey, man, I love you, bro. Is that everybody has a direction. And it's not always about making money. It's not always about the financial rewards, because you can be hired and have a great job. I mean, a really high-paying job when I say great. But you hate the job. It's tremendously long hours. Let's say it's 90 hours a week. You're just a freaking modern day slave, right? And the money will wear, the nostalgia of having the money will wear off. But at some point, your happiness will suffer. And there's no price that you can put on your happiness, right? There's no price that you can put on your dreams and goals and all that good stuff. So you're going to get frustrated with that, and you're never going to stay in that kind of situation. It's going to burn you out. So it's not always about money. It's nice to be able to make money doing something that you love. But truly, the path that you follow in life, whether it's stock trading, real estate, whatever it is, the point of having this question in here is you have to follow what it is that makes you happy. Because I don't know what the statistics are, but I think it's 80,000. I don't know. I could be totally wrong. Get out a calculator and do the math. You work an 8-hour day on average, just for mathematical purposes, 5 days a week for 40 years, right? 30, 40 years. I mean, you're going to spend multi thousands of hours. That's going to take up the most of your life, right? I've been working ever since I was 11. I had a paper route. I'm 50 now. So, like, I'm still working. So it's like my whole life I have worked, right? In some format or the other, I have worked. That's just what I've done. So you're going to spend most of your life working. You better be doing something that you like, right? So anyway, let's move on to the last question. Last question is, if day traders can make money on both sides of a trade, long and short, why do so many care about what the market does? It would seem they should not care so much, since whatever it does, they can profit from it. Good one there, buddy. All right, so there's some truth to that. Why pay attention to the market? If you're trading a stock, just pay attention to the stock, and that's what you should do most of the time. However, the reason that traders look at the market, and I'm going to be speaking for myself because there's going to be traders that don't look at the market. There's going to be traders that utilize market data for different things. I can only speak for myself and my strategies and my habits and behaviors. So, take it for what it's worth. Paying attention to the market is what kind of I was saying in question number one. It gives us a clue. It helps us. It's like another tool. Yes, I'm trading stocks. I'm not trading the market itself. Sometimes I'll trade futures, etc. But for the most part, I'm not trading the market. I'm trading a stock. But there are clues I'm looking for the market. And what I'm looking for when I get up in the morning, the first thing I do is I look for where's the area where this market gets super bullish. Where's the breakout where this market can get extremely bullish. Where would we be extremely bearish? And then anything in between that, the third would be we're just in a chop of a range, okay? So, for example, I'll look at the SPY, which is the S&P 500. So if it's up, and just being up or down, I also will call that flat, if it's within a normal behavior, a normal range, let's say. And I've said that a lot before stocks. Trading stocks, a lot of it has to do with what range that you're in. So, for example, if the market is up 50 cents, the SPY itself 50, 60 cents, down 50, 60 cents, I consider that to be somewhat flat. Same way if the Dow is up 40, 50 points, or down 40, 50 points, that to me is pretty much within a normal range and sort of a chop back and forth day. And this is where numbers in the market can kind of get deceptive, because for the normal person that doesn't trade stocks, they look at it, they'll come back, maybe at the end of the day, they look on the internet or whatever it is and says the market was up 60 points. Like, oh, it's a green day. Good. Economy's good. Market's good. Good. That may not be the whole story. You know, the thing might have been up 200 points, went down 300 points, floated and went like this the whole damn day, and then finally in the last 30 seconds it pops up and closes 60 points. It doesn't always tell the whole story just looking at the numbers. So what we're doing is we're looking at levels, because the strategies that I use most of the time we're in a sideways level where we're just in a moving market, up and down throughout the day. And when it's doing that, I'm looking at stocks and I'm focusing 100% on the stocks. However, when it starts to get overbalanced into one area, so for example, let's say it's just bullish as all hell, right? It's just going up and it won't stop going up. And it's not really pulling back either. And it's way up there. Maybe it's $2.50, $3. You're just going nuts. And the charts are just looking like this. It's going to be really hard for you to short stocks in an environment. Now, it doesn't always work that way, but there is some truth to the statement of a rising tide lifts all boats. And when the market gets extremely, extremely bullish, then it's difficult to go against that. You're on a severe trend. So when you're in a severe trend, you can be more aggressive with longs. You can be more patient with your longs. The strategy changes. So when you're looking at the market doing that, you're assuming that it will translate to most of the stocks that you are trading, and they'll have a similar behavior. It's not guaranteed, obviously, but they'll have a similar behavior. Same way when the market goes down, if it's 2-3 points to the downside like that, then it's going to be real difficult to hang on to a long. You're going to get a different behavior out of that stock, okay, in most cases. So that's why we look at it. You know, number one, I look at it because it's clues. It lets me know sometimes what side of the trade I should be on. You know, if you're sitting there and you're long a stock and then all of a sudden you see a big, huge red bar dump like this on the market, then maybe you should think about something might be happening, and that'll end up over into my play. This is something I need to be paying attention to here because this is an abnormal event. You know, maybe it doesn't do anything to your stock, but still, it's something that every trader should have in their toolkit that you should pay attention to, get an idea of what the whole entire world community of traders and investors think about the market, how they're translating the market, and where their price levels and such like that. I hope I answered that question for you. So, you know, take it for what it's worth. Anyway, that's going to put a wraps on the 5-3 or the 5-3. Or don't forget, if you have questions, send them. Support@thelincolnlist.com. Until the next happy hour. Thanks for watching. Take care.